what's going on, everybody? It is Tuesday, August 30th. We had another big down day. That's 3 days down after Powell's are going to inflict pain. Yesterday was a net drain of 10.7 billion. That was the fourth drain of the month. It was the second largest drain, so that might explain some of yesterday's weakness. It is not a significant drain. It's normal in the course of a month to have, you'll have some days where you're going to get a little bit of a net drain. So no big deal. Thursday is September 1st. September 1st, that's the first of the month. So we will be getting the normal first of the month payments. That's a big fiscal flow day. That's usually over 100 billion. So I anticipate that the current period of market softness, that's gonna turn around by Thursday, Friday. Well, Friday we get the jobs report, but that inflow of fiscal flow, that should take us into the mid-September, that September 15th tax drain. And just to reiterate what I said yesterday, I don't think anymore right now that the September 15th tax drain is going to be that big of a deal, because we're at 218 billion for the deficit here in the month of August. That's the biggest deficit since November 2021. We still have 2 statement days left in the month, so we could still be up around 230 billion, like I said yesterday. That's good. We're going to get a big September 1st, first of the month's payments day, so that's a big net positive fiscal flow. And by the time we get to the 15th, I still say that 4,100 on the S&P, that is more or less fair value, even when you include the 120 billion anticipated tax drain on September 15th. Okay, so anything below that threshold, like right now we're below that threshold, I see that as the market like way ridiculously oversold. A couple of other things. What's interesting is that since the Fed, because everybody, when it was this lead up to the rate hikes, remember, and I talked about this, the narrative out there was, and you heard this from everybody, not from me, but you heard it from everybody out there. The narrative was, that's gonna kill, lending and credit, and the consumer's gonna pull back, and blah blah blah. All right, and I said that's not how it works. That's not what's gonna happen. And since March, when the Fed raised interest rates, and they've raised rates 4 times now since March, loans at commercial banks have increased by 600 billion. 600 billion. That is a massive increase in a very short period of time. In addition, I will mention that March is when the Fed stopped QE, quantitative easing. There's this whole universe of people out there who believe, and this includes, by the way, economists and central bankers, who believe that when central banks do quantitative easing, then that gives money for the banks to lend out. And I said, no, it doesn't work that way. As a matter of fact, it works the opposite way, that when central banks pile trillions and trillions of reserves onto the balance sheet of banks, that hinders their ability to take on more assets. Reserves are assets. The banks have to comply to certain regulatory ratios, the leverage ratio being one of those ratios. And, either they have to raise more capital, or they have to slow down the rate of growth or the rate of accumulation of other assets, loans being assets. And so it should be no coincidence or it is no coincidence, I should say, that when the Fed stopped QE in March, we saw this big surge in lending. And by the way, when QT starts, that's just going to accelerate the lending trend. So, the good news is that whatever fiscal contraction we have seen since the end of last year, and it has been significant, we're down 1.7 trillion year over year on the deficit. That is a net drain of 1.7 trillion, almost 2 trillion, taken out of the financial balances of the economy. I talk about the swimming pool analogy every day. That's draining the pool by a lot. All right? But bank lending has been an offset. All right, credit creation has been an offset. I don't know about you, but I mean, every time I go to my mailbox, I get 50 different offers for loans. The other thing I want to talk about today is I kind of along the lines of mental game. I haven't talked about that in a long time. It's very, and this is not a criticism. What I'm going to say now, it's not a criticism. It's an observation, and it's something I think many of you probably struggle with. It's normal, but people have a hard time controlling their emotions. And if you're going to be in this game, if you're going to be an investor, I mean, it is imperative that you control your emotions. I mean, if you see what's happening over the last few days, and certainly, well, definitely since Powell's 8-minute speech on Friday, market down 1,000 points. I mean, it is absolutely obvious and clear that people are reacting in a highly emotional manner. Oh, interest rates are going to go up. Oh my God, it's the end of the world. It's terrible. It's horrible. If you look at the history of the stock market, I mean, if you look at the growth in the economy, we've had periods of rates going up, we've had periods of rates going down, we've had, all kinds of periods of changes in monetary policy. It has to do with the growth potential of the economy, and that basically comes down to, some entity being a net spender. For us here in the United States, it's the federal government that runs big deficits. And then along with that, having the resources and the labor to produce things and to expand output. And, we have that. So this whole rate thing, and I've been going over this now for weeks about how it's really inconsequential. It only has import. It only has an impact in the sense of how it causes people to react emotionally. Folks, you got to control your emotions. If you want to get some insight into this, I would recommend reading some books by professional poker players. I just saw a very interesting interview on the Lex Fridman podcast. I'll put up the link. I don't know if any of you follow Lex Fridman. He's an intelligent dude. He has a widely followed podcast. He gets interesting guests on there. But he just interviewed this woman, Liv Boeree. She's a professional poker player. She's has a degree in astrophysics. Very intelligent woman, young woman, very, very intelligent. She talked about the mental game of poker. And it is so similar. I've been a trader for over 40 years. I mentioned this many times in the past. I've been a member of 4 different exchanges. I traded on the floor: Chicago Mercantile Exchange, New York Mercantile Exchange, the COMEX in New York, the New York Futures Exchange. I traded on a trading desk of a big bank. Mental game. I mean, controlling emotions. People are reacting now in such a hyperbolic way to something that's really, really irrelevant to the economic outlook, over a period of time. And even, I should say, even in the short term, other than what that emotional behavior causes. I mean, you have to, if you are an emotional person, and again, this is not a criticism, and it's just an observation, and even myself, who I have a lot of experience in markets, I mean, there's times when, somebody put up a comment here in one of my videos, Mike, you seem frustrated. I am frustrated many times when I see stupidity taking over the behavior. And just like, that is frustrating to me because I've been in the game a long time. I understand the economics and when I see that, yeah. But that's a weakness on my part too. I mean, I gotta control that emotion. And sometimes maybe I express it here and so it happens to everybody. But it's really, really important. And by the way, let me mention this. It's not natural to be able to control your emotions. I mean, the emotions are driven by a part in the brain that is still very, very powerful within us. And that goes back, that's like the primitive brain, which controls your fight or flight response. It goes back to when we were just, Neanderthals and having to run away from a saber-toothed tiger or something like that, to survival. But to equate, these fluctuations in the market and something as silly and ridiculous as Fed monetary policy, and allow that to trigger a fight or flight response. This is what is happening. Okay, this is the explanation of what we are seeing right now. There is no economic reality or condition under which these rate adjustments have any particular lasting impact on the economy. It's an income redistribution like any other. Some people lose, some people win. In the aggregate, it all stays in the swimming pool. As a matter of fact, in the case of rate hikes, which is the condition we're experiencing right now, it's literally filling up or helping to fill up the swimming pool. And that's all you need to be concerned about. It goes back to what I said a couple of minutes ago. As long as we have some entity net spending, and it doesn't have to be the government, it could be an entity domestically, okay? Like, I'll give you a perfect example. In the lead up to Y2K, if you were around, when everybody thought when we turned to the year 2000 that airplanes were going to fall out of the sky and computer systems all over the world would crash because they didn't know how to go from 1999 to 2000. At that time, there was a massive amount of capital spending, capital investment to upgrade systems. That was done, the private sector. The government was actually trending towards, this was Clinton's second term, the government was actually trending towards a budget surplus. They were running a surplus, which was very, very negative. But that surplus was counteracted by net spending by the private sector to upgrade systems. So we had a big, giant rally they called it now the dot-com bubble going into 2000. When 2000 clicked and the planes were still flying and everything, the lights were on, that was it. I mean, all that spending and investment was done, and then when everybody turned around, not everybody, but at that time the government was running a big surplus, and boom, everything went straight down. You didn't have a net spender anymore. Okay, or in the case of, you might have look at China, who was or look at Japan, who was the net spender, because they are net exporters. They run trade surpluses. Well, not Japan right now because of the energy situation, but China runs trade surpluses. So we are their net spender, okay? So as long as you have that, and as long as you have the resources and the labor available, and nowadays, with automation and everything, and really you're talking about a global economy, which I've said in the past is like a closed system. You could tap into labor outside the United States or wherever you are, generally. Although right now it's a little messed up with all the sanctions. But these are not conditions that people should be, they're losing their minds over this monetary policy. And I don't really blame them because, like I said yesterday, monetarism has been ingrained into people's brains for the last 50 years. This is Milton Friedman, who, by the way, at the end of his life, didn't even believe in the stuff that, you know, he was promulgating during the course of his career. He made this very, very popular, this monetarism. But it still dictates everything. So what I'm saying is now, work on that. Controlling your emotions. When you're emotional, you cannot make good decisions. And this is what's happening right now in the mass. Okay? Bad decisions are being made. I'm going against it. And I know I'm going to be okay. More than okay. But I'm trying to get you guys to see it the same way. All right, that's it for today. See you tomorrow. Bye.